Once again, good morning, and thanks for a very nice presentation. Um, Let me just try something from, I will make it less theoretical, but there is something the economists will call uncovered interest parity. So, how does it work? You investment goes to where interest rate is relatively higher, and it can also be a race to the bottom. So I raise my rates, and if you don't raise your rates, investment comes to me. Then you raise your rates, then investment goes to you. Then it goes in a cycle of equilibrium, right? So if everybody keeps raising rates, then the best is to maintain high rates. Otherwise, lowering the rate implies that there will be investment flow reversal to countries that are raising their rates. Um, that's a big of problem, but it works in the context of something they call impossible triangle or unholy trinity kind of thing. That you are not going to have an independent monetary policy when you are having an exchange rate that you want it to be flexible, and at the same time you don't want to do capital control. So you want your rate to always go with the market, and you don't want to do capital control. Then it will be very difficult for you to start having something like an independent monetary policy. Independent monetary policy is ability to lower your rate or increase your rate as you wish. In other words, if you work or operate in the global context and other countries are raising rates and you don't want to have capital control, then you have a monetary policy that cannot be independent. You then have to continue to raise your rate. So in different parts of the world, they've been succeeding in that. We are still having some challenges there because of the monetary transmission mechanism. The way interest rate works through the economy into the real sector is relatively weaker here. So to that extent, we are vulnerable to what is happening in the rest of the world. As long as they keep raising rates or maintaining relatively high rates, the premium from our investment and their investment lowers, then people will prefer their investment to our investment. Then we too have no choice but to start raising rates.
Okay, so if we decide to play that global game and we keep our rates elevated, the real sector is already suffering from that. So how do we balance wanting to maintain high rates to attract foreign inflows while foreign companies are leaving our shores, those that are local are closing down? How do we balance that?
Okay, so it's a lot of problems, really. If you operate in autarky, you can do a lot of things, but if you are in the global world, it's very difficult for you. Investors know where things are better than your country, so they will likely go to those places. Can we blame the central bank? Maybe no. The central bank is like a carpenter to every problem. That is what they have. So it's just for us to be able to solve the other problem from the fiscal side, fiscal policy, monetary policy, income policy, such that it is not only the monetary policy that we are using. And people have said it a lot of things. I mean, you don't need to be an economist to know this, that the inflation in Nigeria is not always demand pull, it's also cost push. And interest rate is a major factor in the cost of production, whatever anybody does. Then raising the rates, you mentioned Dangote now, raising the rates also means that the cost of production goes up. Then they produce less because they become less profitable. When they produce less, the next round of it, prices go up, inflation goes up, the central bank starts raising rates again, then cost goes up. Then you keep on raising rates and you are not solving the problem. So what do? You have to balance monetary policy with fiscal policy. You have to then sit down and say, we are raising rates. By the way, I would like to say something about raising rates. Traditionally in economics, when you raise rates, it does two things. Savings rates should go up, then lending rates will also go up. Savings rate will go up so that people can, instead of spending their money, save their money. So from the household side, you're actually taking money from the economy. Then from the firm side, you are also discouraging them from borrowing. But in the case of the country, you have saving rate that is like maybe 2% or 3%. So raising monetary policy rate does not actually increase savings, So that leg is broken. It only discourages lending. And that is like flying with one wing. So you must have a situation where the gap or the premium between savings rate and lending rate narrows before you can have that to be effective. And that's a lot of the banks will always tell you, we have invested in a lot of costs, we have to recoup our costs, collateral is there, a lot of factors that you have to consider. But you must be able to reduce cost of doing business for people so that you can narrow that premium. Otherwise, you are not going to solve any problem. Then another thing you can do, you may also be talking about how do you ensure that people have access to some kind of concessionary loans, especially those that are involved in reproduction, not financial. I mean, most people here are financial people, but you must also give them access. So interest rates can be whatever it is with MPR, but if you are doing certain activities, you have access to this type of. There was a time the central bank was doing something on the cash reserve ratio to say keep the cash reserve ratio, but we can use it for something that is less than 9% or 10% in giving loan to manufacturers. Otherwise, it's actually a very big problem for the country.
Okay, thank you. I'll come back to the use of intervention funds by the CBN, but just to let us know that we can also ask questions. If we have questions, we can just signify and the mic will come to you. So that's where I was going to, that if we are targeting inflation, and though when this new CBN came in, they did expressly say that they were going to target inflation, and all the intervention funds were like, shut down somehow. But I'm thinking, could we not do both? So we target inflation, but just so that the real sector doesn't suffer, we still use those intervention funds at concessionary rates and fund the real sector. That's something we can look at. Yeah,
definitely. But I think, when you come in as a new central bank governor, normally you will say, I stop all those kind of. As you see reality, then you start making allowance for those things that you yourself banned some times ago. So I think by the time they see more and more. Another issue is that people are not actually against intervention. They are against who is doing the intervention. If it's from the central bank, then they said, oh, how does he work with your primary objective as a central banker? For instance, let's assume the Ministry of Agriculture has the capacity and the corruption level is low and the effectiveness is high, and they can give fertilizer and do all those things that central bank is doing for agriculture. I mean, several years ago, if you ask the Minister of Agriculture, what are your plans for agriculture? I'm sure he will be mentioning Anchor Boa program, which is not for Ministry of Agriculture anyway. If you go to aviation, what are you doing? The minister will probably be mentioning what the central bank was doing. If you go to trade and investment, they will be mentioning we ban 43 items. I mean, these are CBN policies, but working into their own turfs. So I think it's also important for us to start talking about, it shouldn't be central bank, because central bank then gets so powerful. The central bank then become a quasi-fiscal authority. Yeah. Then how do you now rein in a central bank? I think that is the problem. So I'm not sure people are against intervention. They are against who is doing the intervention. If we also have institutions in the fiscal side, in BOI, all of them, if you are doing their work well, to the effective level that we think they should be done, I think we are fine with intervention, really.
All right. Thank you very much. Any questions from the audience, please? Okay, we have one question. Thank you.
Good morning. Thanks for the comments. I'm an investor. My name is Adito Badiyemi. And my primary question is the way the stock market moved in the last quarter of last year right up to January. And for some of us that are not professionals, it caught us by surprise. Things like Access Bank moved from 9 naira to 13 naira across board. And I've asked people differently, and I get different answers. So I just want to use the opportunity of people gathered in this room. Maybe I can get a definitive answer to this question. Thank you.
Okay, that's the drivers of the Access Bank share price from 9.
Not specifically Access Bank. I guess all of them did it. UBA, Access, and a couple of other things. I just picked up on Access because I had a lot of position in Access.
Okay, can I try? I mean, that should be for him, but I'll try. And not Access now. So what determines stock prices? I mean, not returns. Now, returns is determined by risk, but prices are determined by quite a number of factors. let's look at them in three ways: the macro factors, the industry, and then the stock-specific factors. Macro factor, the major macro factor that determines stock market anywhere in the world is liquidity. If people have money, the price of this pen can become 10,000 naira. All of us have money. Do people have more money? I think so. Devaluation, a lot of people actually have more money. I mean, look at what happens to our debt, for instance. Our debts move from whatever it is, 41 trillion, then 98 trillion, then 121 trillion. And I just did an analysis that showed that 30% of that was as a result of devaluation. So some have more liquidity. One, two, others are also thinking, these are international banks. Some of them have positions that they can convert back to naira. Some of them actually did, and they are going to declare something far bigger, better in the future. Why don't I take position into this? So I think a lot of factors went into that space. Forex was a major factor that determines things. It led to more liquidity, and that's one of the reasons why the country will try to rebase its GDP. If you look at our money supply moving from about 60 trillion, 50 trillion, 60 trillion, now close to 100 trillion, a major factor of that is also devaluation. So that's increasing liquidity, in addition to the possibility of some of these companies paying dividend and people taking advantage. More demand, definitely prices will rise. As you then tends to see, maybe exchange rate will not go beyond this value. And the other last factor is that when you have a devalued currency, domestic assets become relatively cheaper. A dollar that could buy a stock before can now buy two stocks, and in this case now 3 stocks, because our money actually went 3 folds, right? So more demand, more liquidity, prices go up. Possibility of paying higher dividend because they are going to add translation, whatever, prices go up. People rush into it, more people rush into it, prices go up, and then, but now, if we have stability in the forex, less liquidity, the way things are going, you may have people say, wait a minute, how did we get here in the first instance?
Yeah. Okay, just riding on that question, for the general investment asset classes, what should we be looking at? What factors should we be considering going into the second half of the year that will inform investment decisions?
Okay, first, I will say minimum wage. Minimum wage for about 3 or 4 reasons. Number one, I'll be interested in how many states can pay, whether I have investment interest in those places, whether there will be labor action, not at the federal level, but at specific states, pockets of states. I'll be interested in that. Second reason why I'll be interested in minimum wage is that minimum wage will increase the wages of people at the lower side. What do they consume? 53% of a consumer basket in Nigeria goes to food. Another 5 or 6% go to energy or whatever. Another 5 or 6% goes to transportation. So food, transportation, energy, and housing will probably take over 70 to 75%. So what are they going to be buying more? They are going to be buying those things more because they're actually under consuming them in the first place. Investment opportunity, yeah, who are the people producing those things? Maybe the prices will go, especially if those people are already paying higher than minimum wage, so it's not going to increase their cost of production. If they are also in a sector that are commodity related, where they can transfer increased cost more easily to the consumer of their products, then most likely the prices of their stocks may do relatively better. So that's the thing I'll be thinking about them. For the ones that are earning a lot of money far below, above the minimum wage, you are not going to have their salary double. There will be what they call consequential adjustment. They probably will give them 10%, 5%, depending on how they are going to graduate it. So what are they going to buy? They will buy more durable consumer goods. They are not going to consume them in terms of... So more durable consumer goods, and they are going to buy investment. So he has 10%, 20% increase in his salary. It was already earning high. Is likely, that's his permanent income hypothesis, is likely to invest that money, not consume that money. So those kind of people, what investment assets, what can I sell to them so that they can come into the market and invest more? So I can then divide the market into 2 or into 3. The last part is of that minimum. Okay, so let me leave minimum wage. Another thing that can also shape H2 will be Dangote refinery, depending on the way it is operationalized, opportunity harnessed. whatever is going to happen to energy prices and the rest based on that. Another factor that I will mention is Kenya issue is very interesting. I don't think we should be expecting more pro-Libra policies from our government. What I mean is everybody kind of think IMF, backlash, IMF, World Bank. For now, they are like, are they enemies or friends? So if I'm a president and someone tells me, remove more subsidy, PMS should be 1,200 by now, I will say, hey, wait a minute. Let's think about it more. Yeah. Or liberalize more, it should be 2,000 naira to $1. I will say, wait a minute, what can we do, central bank governor, to make sure? So I see that to also be government being more relatively careful. Yeah. Banking consolidation is very important. Are people already taking position? This money that they are bringing in, is it money that we were not using before? In other words, are we just taking money that we are very using, or fresh fund? If they are not fresh fund, not much impact. But if they are fresh funds, then definitely there will be impact. Yeah. And lastly, how do we use technology in the new issuance of tech? Because this is also tech thing. Technology in issuing new securities. I think SEC is working on that a lot, to make sure that the problem we had in 2005, 2007, as people having multiple subscriptions, and that's now leading to unclaimed dividend, unclaimed shares. Now with technology, some of those things can be solved. So we can have a better primary issuance process going. So the market will definitely go up as a result of some of these activities.
Right. Thank you very much. I'll just take one final question from the audience before I come back to you for your final comments. One question from the audience before our final closing remarks. Yes, sir. Please, the mic.
Thank you. I just wanted your thoughts on crude oil production and what that means for Nigerian economy in the second half of the year. We know, obviously, it affects exchange rate and all that. So what are your projections? Do you expect crude oil production to go up? If yes, what are the likely implications? Even though, what are the likely implications?
My wish, it should go up. Well, if wishes were horses, I would like, I think there are more fundamental problems that we see sometimes. Government would do, I think this year is 1.78 in the budget. I mean, some of those are wishes. So wishes have always been around us. And witches are similar. so that we don't get bewitched. So they should go up, but I think even when we do 1.2, 1.3, we have done well, even though we want to do far more than. There is something that actually, see, investment in this sector has been declining a long time ago. And people who are saying investment was declining, it's just like when you saw, Shell has sold this to Seplat, they have gone. Everybody celebrates. Our people are now coming back. There was a time I was looking at, was it Learn Africa, was Longman. They said, we are not ready for Africa. I think Africa has grown. We need to sell this stock to Africa. Our people have taken over. I said, go and look. For them to say they are going, there is something they saw. So, if investment has been, go and check our FDI. We are not doing anything in FDI. It has been falling. That means nobody is bringing capital into that sector for many years. Then someone wakes up and say, budget of next year, 1.8 million barrels per day, and we clap. If wishes were horses, that's why. That's why.
All right, thank you very much. Your closing comments, sir, concerning our take on the outlook for the second half of the year, and just that. Pick any of the economic aggregates.
Okay, so growth, so 2.98. If we must meet 3%, then that means we must do 3.2% for average that. If we must have inflation, that will be about 26 to 28%. We must do inflation that will be trending down to about 25% towards the end of the year. So one will expect inflation to come down. But please, this is it. that inflation rate is coming down doesn't mean that prices are falling. You know, governments can play that game and say, oh, inflation is now 28%, prices are coming down. Prices are never coming down. Prices are just increasing at a reducing rate. But government will play the politics of prices are coming down. So inflation will still be high, but it may trend down to about 28, 27% towards the end of the year. Growth, we should have about 3.2% if we have anything that is reasonable. And I think our current account balance improved from 1% of GDP to 2% of GDP. One should be expecting us to have a current account balance that will be about 3% of GDP by the end of the year. Why? We are having a lot of flows, more flows, still around 10% increase last quarter from the capital importation report that was just released a couple of days ago. Yeah. So we may have more inflow of capital. If those more inflow of capital are properly utilized, especially for people who want to import things into the production process, and if we can also address the security challenges, I think that is a major issue. Yeah. I think they are back. If nothing is done about that and food prices keeps rising up, it's still going to be more mystery for the economy. But I think the president and his advisors also should not be closing their eyes. We are learning from things that are happening. You show it to us all over Africa. They definitely would like to have something to show before the end of the year. So I expect some slight improvement in the economic indicators towards the end of the year. Thank you.
Thank you very much. Please can we put our hands together for Dr. Olowookere.